Alright guys, welcome back to MMGinvest and WolfPack Cryptos. In today's video, let's talk about the stock market and the bond market. First of all, this is not financial advice, this is just my opinion. This channel is more about education and learning how to trade and economics and all of that fun stuff. So, the yield curve, it's still inverting, and I've talked about that numerous times. First of all, let's get something straight here. In my previous videos, right, when the stock market started correcting, as you can see right here, when all of this was happening, right, I was saying that the top, the all-time high, is in. And I've also said that this is a bull trap. And there's already a few people saying, oh, I'm wrong, and the stock market's going to go to all-time highs. It's going to keep rising and rising. All right, well, listen, I am right no matter what happens. I know, I just said that. If the stock market falls and we don't make a new all-time high, and this is it, right, and we go into recession, depression, whatever, I'm right. If the stock market goes higher, and it keeps going higher and higher, it goes past all-time highs. This is S&P 500 daily chart. If it goes past 2,900, goes past 3,000, I'm still right. Do you want to know why? Because I don't care what the stock market does. I only care about what's going to happen to gold and silver, because that's my real trade. You see, instead of shorting the stock market, which is dangerous, you could just buy gold and silver stocks or trade the ETFs. And you're still shorting the stock market, except the downside risk is very minimal compared to the upside potential. If you're shorting the stock market, there's a lot of risk. And that's why I don't like shorting. If anything, I'll buy an inverse ETF to equities, like inverse QQQ or Russell or one of those ETFs, right? Which the PE ratios on those companies that comprise of those ETFs is like through the roof. Anyways, the reason I say that is, this is the Venezuelan stock market. And look at this. People are starving, right? They're starving to death. The economy is fully imploded in Venezuela. They barely keep the lights on. But look at their stock market. It keeps going higher and higher. So just because the stock market's going up, that doesn't mean that the economy's not crashing. Why is that? Why is this happening? Why? This is the Venezuelan stock market. Look it up. Yeah, it did crash right here. It just dropped like a rock. But it's still historically high. I mean, it's still higher than it was in 2018, 2017, 2016. Their hyperinflation really started kicking off. I'm not exactly sure. I think 2012, 10, 13. It's when the inflation really started taking off. And look at their stock market. So, you know, the economy, it doesn't matter what the stock market is. The real economy is detached from the stock market. And that's because stocks go up versus the fiat currency. Now, if you adjust the value of the stock price to inflation, then when you go to sell your stocks, you lost money. But relative to fiat in fiat terms, your stock went up. Let me explain this. So Google could go up 500% in the next 10 years. But if you adjust it for inflation, for the amount of value that the dollar fell, you could sell your Google stock like 5 times the value it is today in fiat terms in dollars, and you still lost money, even if it went up 500%. So you have to understand this correlation. All right? So if the stock market goes up, goes past all-time highs, the reason it went past all-time highs was because the Fed is starting to lower rates again, and it's starting to print more money. It's coming in with more QE, quantitative easing, right? So if that happens, yes, the stock market's going to keep going higher and higher. But my gold stocks are going to go up even higher if you adjust it for inflation. All right? Now, let's take a look at the yields. Here's the S&P 500. The blue line's the S&P 500. This is a weekly chart. The candlesticks down here is the 10-year yield on the 10-year bond, treasury yield on the bond. You can see that you can see the divergence, right? The yield has been falling since 2009 like crazy. They've kept them artificially low, and the stock market's been taking off. And that's because the lower the yields are, the more money is being lent, more fractional reserve lending is happening, and then they also did quantitative easing as well. Now you can see that they've been raising rates since the end of 2016, and it's been slowly rising, and it's only risen to 2.5%, which is nothing. And you can see that the stock market's starting to flutter. It's losing momentum. There isn't as much money going into Wall Street, going into the economy and these corporations. They keep doing corporate buybacks as well, which also pumps up the market. So that's how the rich get richer and the poor get poorer. All of this quantitative easing, low interest rates, it goes into the stock market. And then who benefits from that? The rich. People who own assets and who own shares of corporations and companies. And the corporations get richer, right? Meanwhile, your average Joe Schmo doesn't get richer. Now, the middle class, yes, they do have some retirement and Roth IRAs and whatever. But those, it's just paper money. But the baby boomers are going to be forced to start liquidating their retirement, right? So they can live off of it. So that's another reason why the stock market cannot keep going higher and higher. And everyone is just very complacent right now. Very complacent. They think it's going to keep going higher. And yes, technically it can. But I'm telling you, if the stock market's going higher, they're sacrificing the dollar. And they're sacrificing the real economy to make the stock market go higher. And Trump's going to say, it's the greatest. The stock market's never performed like this. It's the greatest economy ever. No, it's not. The stock market does not reflect the real Main Street economy. It's just a financial bubble. And when it pops, the real economy is going to suffer even more because the corporations are going to go under and everyone's going to lose their jobs. So, yeah, stock market could go higher. I don't care. I'm still going to make money. Because I'm not shorting the stock market by just straight up shorting it. I'm buying gold and silver stocks. You guys have to understand that. And people in the trolls in the comment section, they're retarded. They don't understand this. Alright, so, why can't I do this? Why am I... So... Let's go back to all the charts. What is this? I'm on the wrong one. Alright. So, here's the dollar. And I'm not going to do, I'm not going too in-depth with the TA. There's many, I'm just talking, I'm just thinking out loud. Alright, guys? It could be wrong, right? Short term, the dollar, yeah, it could go up if Brexit and Europe are having major problems in China. At the same time, the dollar could tank at any given moment if the Fed is forced to capitulate even more by saying, all right, we're going to start cutting rates. And you already see this talk on mainstream media. Look at this. Look at this. Brace for rate cut. So they're talking about that on MSNBC because there's another FOMC meeting coming this Wednesday. Trump's tax cuts forcing Fed to ease rates. What? What do the tax cuts have anything to do with the federal funds rate? Nothing. Nothing. This is just a blame game. And I talked about that in my last video, right? The 60 Minutes interview with the Fed. It was literally a blame game. Basically, they were prepping the public, and they were putting out there all of the things they could blame besides themselves. The global economy, Europe, China, trade war. What else? Watch that video if you haven't. I like this, though. State Attorney General warns Facebook, Google are too big. They are. They're monopolies. But this is probably grandstanding. I mean, they're not going to do anything because guess who owns DC? It's these mega corporations. Treasury yields look past strong equity performance. So what are they saying by that? So the yield is signaling... Where is it? The yield is signaling. Let's go to a smaller time frame here. Let's go to a 4-hourly. Yields keep falling on the 10-year. On the shorter term yields, the shorter term debt, the yield is rising. That's how you get an inverted rate. So when the 30-year and the 10-year start dropping the yield on the interest rates, that signals that the stock market is going to have a correction. And you can see right here that the yield keeps dropping and dropping on the larger bonds. And it's signaling that this is possibly a bull trap, like I've been saying for the past few weeks, right? And months, that this will be a bull trap. And you see a lot of buying come in. They're buying bonds, but the yield is dropping. And if you look at a historic chart on the 10-year yield, we've been in a multi-decade bear market on yields, and that's going to flip. It has to flip in the next few years, right? Because it can't forever keep going down. I mean, the Fed might permanently or somehow force yields to be permanently low like Japan did, but it's not going to work out like it did for Japan. You're not going to just have stagflation for decades. What you could end up having is just turning into Venezuela eventually. And the way things are politically looking in the U.S., if we get socialism, it's going to be Venezuela. It's going to be. There's no way of stopping that. So the bond market is telling me that this is a bull trap, and I called this. Now, the only way that this doesn't turn into a bull trap, what will happen is the stock market, what could happen, so there's many scenarios that could happen, but this is what's probably going to happen. So let's delete this arrow. It's no longer valid. Let's say the stock market sells off again. If it does this, rate hikes are off the table and they'll start talking about rate cuts. So lowering the interest rate back down towards 0. And then what will happen is for next year or a year and a half, you know, the stock market could trade sideways for a very long time. Now, if it starts falling back down further, starts revisiting this low we just had a month ago, the Fed's going to freak out. And then they're going to bring QE and quantitative money easing printing back on the table. And what could happen is the stock market will start just taking off like a rocket again. And let me take it to a weekly chart so you can see this better. And what will happen is we could the stock market will just go past all-time highs. But if this happens, right? What's going to happen? The dollar is going to be sacrificed. The dollar will tank. Gold and silver will go to the moon. I mean, once the stock market pulls back again, which could be any day now, next week, this week, gold and silver is probably going to start taking off again. This entire time, gold and silver will be taking off like a rocket. But once they do QE again, right, and the stock market takes off like a rocket, gold and silver will take off even. They'll go past their all-time high of gold will go past $2,000. Your stocks are going to go, I don't know, to the moon. And this will start looking like it'll turn into that Venezuelan chart I was just showing you guys. And eventually we'll get a blow off top. And I don't know. I don't know how long this will last. But that's what could happen. So just be prepared for that. That's why you don't short the stock market. Because if anything, it's in their best interest to keep the banks from going under and keeping the stock market from going under. Because once corporations and banks start going under, the public will freak. They'll riot. You know, you'll have revolutions. And that's what their main concern is. But the public is less likely to do anything dramatic if this dollar is slowly selling off, and because people don't notice that. People don't notice a 2% increase, a 5% increase in the cost of food and everything month over month. Yeah, they will eventually notice it. But by the time they notice it, you know, maybe another year or two has passed. And but the public's pretty stupid. They don't, you know, voice their opinion, or they don't they're not going to complain until it's at the point where they're losing everything. They've lost their new cars they leased. They start losing their homes, and they don't understand why their paychecks just can't pay for anything anymore, and they're already over indebted. By the way, here's another good article. I'll post this in the comment section. Where is it? So, this is not the article. Here's the article. Projected U.S. budget deficit. Line 4 pictures. Budget deficits versus actual increase in debt. So this is the budget deficit for the Gov. The federal deficit is the blue line. Actual increase in debt is the orange line. So the blue line, you can see it's gradually just going higher and higher. And, you know, Trump doesn't like talking about that. And neither do the Dems. Both sides of the parties, they don't talk about the deficit. Because, you know, it's unsustainable, and they don't want the public to realize that. Gross public debt, actual through 2017. By the way, the budget deficit, the baby boomers, the older people, they don't care. They think they're not going to live to see the day of reckoning. And they don't give a shit what happens to their kids and their grandkids. That's why none of them talk about it. That's why nobody talks about it at the dinner table. They'll say, oh, we won't live to see. That's what they think. They won't live to see. They don't care about their kids and whatnot, that they sold out their futures. Gross public debt actual through 2017. So this is public debt. Your credit cards, home mortgages, car loans, everything. and it's just it's starting to go into a hyperbolic chart where it starts going straight up, like the Bitcoin bubble chart. So, and that's what it's gonna do. It's gonna do that. It's gonna go straight up because there's interest on all this debt, and it starts compounding. That's why we're starting to see delinquencies on car loans and student loans. Projected deficits versus projected increase in debt. I mean, these are lies. They're going to go up. These projections that they put out are based off of the economy growing at like 3% year over year with no inflation, with no recession for like the next 10 to 15 years, that's fantasy. All right, so let's take a look at the yield curve because everyone keeps talking about it and freaking out. I mean, not much has changed since the last time, but I found an even better chart I can show you guys. So I'm going to press play, and then here on the chart, the S&P 500 is the blue line. The 1 year constant maturity rate for bonds is the black line, and the green line is the 10-year constant maturity rate for bonds. And these gray sections you see on the chart here, these are recessions and stock market corrections or crashes. So and then on the left here is the yield curve. And I'm not going to post this in the comment section. Some of you guys need to come and visit us in the chat rooms. And I'm going to post this in the chat rooms of MMGinvest, WolfPack Cryptos, and of course the private memberships for both. For Gold, Silver, Inequities, which is MMGinvest, Elite Group, private membership, and then WolfPack Cryptos private membership group as well. So let's take a look at this for a second. Alright, you guys saw it there. I forgot to put on my cameras. There you go, you can see me now. So you guys should come over to the chat groups because I'm not always making videos, right? Here's the newsroom of WolfPack Cryptos. I mean, I keep you guys updated on stocks and cryptos as well. My thoughts and opinions. So there you go. There's two chat groups as well. So I'm going to post that in the chat rooms if you guys want this. Alright. Now, I think I've covered everything for now. I don't want to make this a long video. Oh, let's talk about gold for a second. I think if the Fed becomes even more dovish, I mean, gold's been holding up, guys. It's been holding up pretty well. The weekly chart is concerning because of the oscillators here. As you can see, the MACD just crossed to the downside. But look at this. It did pull back, and it's already moving back up. We have 3 green candles in a row trading above each other on the weekly time frame, which is a bullish candle pattern. So I think, you know, gold could ignore technicals if the Fed becomes dovish and it's above 1300 again, major support and resistance. I'm telling you, once gold gets past this previous high of 1350, 1380 area, it's off to the races, and you do not want to miss out on that. So go to MMGinvest.com. I've done a research report on mining stocks, and you know, some of you guys are going to take advantage of that, and you're going to do very well. Product should pay for itself. Also, these moving averages are about to cross my blue equilibrium line, which is also very bullish. So the price, it didn't quite get to my 1270 target, but it did bounce off my blue equilibrium line, which was at 1280, so I missed it by 10 bucks, the dip buying opportunity. But the stocks, the mining stocks themselves didn't really take off. It's just the gold futures. So it's not like you missed out on the dip buying opportunity. So it's looking good for gold as of right now. I think it could easily ignore some of these technicals and take off. I'm not guaranteeing it. I'm just saying I'm watching gold right now, and the Fed meeting this Wednesday will also determine if it's going to take off again to the races. All right, guys. So visit MMGinvest, visit WolfPackCryptos.io, and check out all the links below this video. Smash that like. Please share my videos, and leave in the comment sections your thoughts and opinions. Until next time.